This is the short-term rental opportunity with Revity, where we educate sophisticated investors on the power of this high-quality investment asset class. Hi, I'm Liz Marie here with my co-host Seth Lowry, and welcome back to the short-term rental opportunity with Revity, the industry leader in underwriting short-term rentals as an investment asset. This is episode 2 of our 10-part series, and today we're talking about what it means to make your short-term rental investment grade. So when we're thinking about investment grade, we're talking about running it to maximize the investment yield. And that's really different from what a lot of short-term rental owners are doing out there in the market. In fact, we estimate that only 3 to 5% of all short-term rentals are really fully optimized from an investment standpoint. The rest are not run to the optimum ability, or they're run by second homeowners, mom and pops who are just renting out their home for a portion of the year.
Yeah, and so we've broken down an investment grade into 4 primary categories. These main categories are operational, economic, regulatory/legal, and then financial transparency. So today we're going to go through and kind of talk about each one of these in depth and the primary kind of sub-bullets that describe these 4 main pillars for investment grade. So Liz, why don't you kick us off and discuss some of the operational drivers and what that means to really be labeled as an investment grade STR asset?
Absolutely. So we break the operational drivers up into 2 main categories. The first is revenue management. And what we often see, you've heard us talk about this on the first episode, and you'll hear it from us again, that it's really important to have a professional vacation rental management company. That's how you're going to yield the maximum return, far and above over if you're just running it yourself. And one of the key pieces of that is their pricing. And the biggest and most sophisticated vacation rental managers in the country have dynamic pricing that adapts and adjusts every single day, often many times a day, to maximize the output and the occupancy for that rental. So many individuals and investors who own, one or a handful of their own properties might change the price every week, every month. This is repricing every single day to get as many people into your rental as possible at the optimal price, and to really ride that fine line of occupancy and average daily rate. So that's a big piece of it, that revenue management piece. And that's the daily pricing, but it's also full channel distribution. So if you're only listing your property on Airbnb, you're doing yourself an incredible disservice from a revenue standpoint. And it can be really challenging to manage, 5, 6, up to even 100 channels. And that's what these vacation rental managers are equipped for. They have the technology and the systems in place to, not have to worry about those crossovers and bookings. And that really yields the optimal performance, really by far. We've often seen even the fairly sophisticated regional managers, when you upgrade those to that professional management, you get, 30, 40% additional return. So revenue management is really key. The second piece of the operational driver is operational and guest services. And we predict this is like up to 35% of the return. And that really goes to the actual management side of the professional management. How are they taking care of it? What is the experience like for guests? What are the ratings and the stars? So for example, having a 1-star rating when you're first onboarding your property can plummet your investment. In fact, we would recommend just moving management altogether and restarting in most cases, because, it can be the difference between $60,000 a year and $250,000 a year if you start with a 1-star, and that's a real example that we've seen. And the final piece of that operational and guest services is the physical asset optimization. So the design, the experience, the amenities. You've probably heard that a hot tub can boost your ADR, or your returns on your rental income 15 to 20% in most markets. But that's not all. We just heard yesterday the difference between 2 identical houses, one that was professionally designed and one that was just kind of thrown together, was pretty astronomical in terms of returns, almost double the overall rental income. So the physical appearance and experience of the design can yield not only higher ADR, average daily rate, but also increases your occupancy as well. So how about, Seth, why don't you tell me about some of the economic drivers of return?
Yeah, so I think this is kind of one of the more overlooked drivers for STR investment success. There's kind of two layers here for considering the market and economic drivers. There's a micro layer, which is, hey, what neighborhood, how close to amenities are you? What's your real nitty gritty ground level positioning for your STR within, say, a city? And then at the higher level, which is the most ignored level, which markets are you investing in? What are the long-term inflation rates of those markets? I think it goes back to the old adage, location, location, location. I think STR investors are generally very focused on their micro markets. So, if you're used to investing in Austin, you have particular views on, hey, I want to be close to 6th Street or not. Those can be meaningful drivers. We typically see up to 25% variance between, those with assets in great areas and within a city and those that are kind of second or tertiary positioned. I'm sitting here in Phoenix, proximity to Scottsdale and Old Town is certainly another example of micro dynamics that can really swing ADRs significantly. I think everyone's pretty well aware of and focused on the micro dynamics. But again, I'd like to just refocus everyone on, hey, if you've invested in Tampa and inflation's running at 10, 12%, that's going to be a substantial driver of your revenue on your STR. And I don't think people are used to thinking about inflation rates. I think everyone's sort of getting a re-education as inflation's running hot in this country. But city by city inflation is just dispersed massively. And so I think having at least put a little bit of thought behind what are the forward inflation rates of where I'm investing can just drive a larger amount of return, 40% plus, driver of STR performance. I'm a Wall Street analyst by training. So it's kind of like the same dynamic of I'd rather invest with a bad stock picker in a bull market than a great stock picker in a bear market. So yeah. One of the things we just like to harp on is, hey, what market are you in? What's the inflation? What's the future competition too? Some places in the Southeast, for instance, Destin, I probably have multiple conversations a week from very large institutional players all looking to crowd into the Destin market. So Destin's got great inflation, but it's also got a lot of forward competition. So I think really putting some thought into, hey, where's a great market to invest? Where's a great micro market to invest within that thesis? That's going to set you up well, and also making sure there's, not everyone in the world is looking to invest alongside you in the same market. Having a framework for analyzing that is going to set you up for success on investment grade. So the next key component, Liz, how do we think about regulatory and legal in terms of investment grade?
Ooh, this is a big one. So, the thing about the regulations is that it can affect up to 100% of your return if you're not doing it right. It can be an absolute deal breaker. And so it's really important to look at let's say 4 key components of the regulatory landscape. So first is, what are the existing regulations in that market? Some investors aren't even aware when they dive into this that there are permitting requirements, there are limitations, there are bans. Some of the most popular markets are really unrestricted, and others are incredibly strict and have quite a bit of red tape, or have banned short-term rentals outright, especially for less than 30 nice days. So that's an incredibly important factor when you're looking at where to invest, down to the property lines. I'll use this example time and time again. One of my own properties is the city name is 29 Palms. It's in a fairly regulated market, but it's right outside the city limits. And so it is significantly less regulated. And there aren't nearly as many restrictions. And that's actually a competitive advantage if you're going into some of these, larger markets that have restrictions and you're getting a more rare asset. The next piece of it is the risk of future regulations. And this is something we're actively monitoring all the time and trying to assess what is the likelihood that in a given market, there will be future regulations. And there are a lot of components of this. Some already have those very specific requirements in place and may be considered more stable. Sometimes the ones that don't have anything in place could be higher risk because who knows what's going to come down the pipeline, and really every combination in between. So, we're actively monitoring the appetite in the community for risk, the types of enforcement, and that's the next one is the level of enforcement. So if you're in a community or invested in a municipality that does have restrictions and they're monitoring them, who's monitoring it? Is it a task force? Do they have the police enforcing this? Is it just kind of a written restriction that no one's really actually paying attention to? And then what are the fines? Or is it even a fine? In some cases, we've seen criminal charges for a third violation in Carefree, Arizona, for example. But fines can range from a $20 violation fee to $20,000. It's an incredibly wide range. And we're seeing these restrictions increase. There's really not a lot of consistency across the board, even from neighboring city to neighboring city. But there are a lot of trends of implementing more and more regulations. So it's important to be aware of what's coming down the pipeline. And then the last piece is insurance management and making sure that you're compliant across the board. And that can come down to, certainly having your insurance on the property itself and liability insurance, as well as, loss of income, which is something that, people don't even think about if they're not considering this as a true business. So, we're always looking for the right insurance providers to recommend. And, that's a factor that many people aren't even considering and what makes this a true investment grade asset, but also a truly effective hospitality business on top of that asset. And then let's go down.
I'm going to add a quick anecdote there, Liz. Just highlighting that regs and market drivers, the number 2 and number 3 of our pillars here, they sometimes go hand in hand. And my favorite example is, recently Las Vegas banned larger format Airbnbs, trying to attempt to limit the destruction from bachelor and bachelorette parties. And again, as someone here sitting in Phoenix, we've just seen a massive influx, especially in the spring season, from all the bachelor and bachelorette parties that have seemingly gone from Vegas down here to Scottsdale. So, there's this cascading impact from Vegas regs, shifted demand, significant demand to Scottsdale and other parts of Phoenix, demand for larger format rentals. Then that caused a cascade with the Scottsdale City Council to create a task force to enforce these, to track and monitor and come up with more aggressive enforcement over time. We're sort of in the middle innings of that. And, we don't know what's going to come of it, but they're certainly trying to tighten down, especially as we're getting all of the large format guest traffic that Vegas didn't want. You can imagine that's a pretty aggressive clientele base for any city council to monitor. So you can see how these factors interlock, and I think that's very underappreciated in the STR market. But I think it's going to be a trend, especially across these markets, as some overreact, and some and that will shift demand to other markets. So regs and demand are more linked than not.
And it's not all doom and gloom on the regulatory front. We're even seeing a reversal of regulations, for various reasons. So there was a short-term rental ban in Manhattan Beach here in LA, where I am, and that was struck down and deemed discriminatory. And then, the other example that just recently happened in Fayetteville, they removed their restrictions. They said, we did this, everything was great and fine, and we weren't having any issues. So they really lightened the load. And I think we'll continue to see those shifts as the pendulum swings, as Seth said, some overreactions and some reversals. And eventually I think it'll settle into something more consistent with, I would estimate, some level of regulation and monitoring, but hopefully not outright bans in most of these environments. And then we have the fourth key pillar and driver of return, financial transparency. Tell us a little bit about that, Seth.
So I think this is the least considered pillar out of our discussion today. It's similar to single family rentals 10 years ago, and it's just kind of the nature of a mom and pop industry and single asset owners. The accounting, the books, the transparency, it's just let's go with messy at best and creative, very financing and line items. I think the industry lacks standards of accounting. Some view cleaning services as a revenue item. Others pass it along. There's a lack of standards in how do you account for ancillary fees like hot tub fees and pet fees and all of these kind of adjacent revenue lines that can either be a revenue line or expense or some, maybe it's neutral. And then you have your core business. Some people do a lot of the VRM tasks themselves. Others outsource it completely. There's just a very wide range of how people come up with their own cash flows and cap rates. I think over time, this is easy. It's an easy fix to get standardized. But, if you want to get maximum value for your rental, and if you want to clearly communicate, hey, this is the earnings potential of my property, and eventually, and we're starting to see this in the market, get full credit on the sale of your asset, you're going to need clean books, especially if you're a portfolio owner, especially as institutional investors come into the market. Cap rates in the short-term rentals are 7 to 10% versus long-terms in the private market, 4, 5, 6. Part of that gap is just people, anytime you have opaqueness or kind of, an inability to communicate financially what an asset can do, you're going to get a discount on your business. That's not an STR thing. That's any asset, right? Transparency equals higher value. So, I think if you have an accounting background, you do yourself a great favor and highly differentiate your property by building a track record and building a track record that anyone can easily discern with a financial background to analyze. If you don't, there's plenty of resources out there, to get clean books and accounting. It's not a monumental effort. The VRM gives you relatively clean books. We also have ways to help you make that cost free. I think cost segregation is a very overlooked or asset to match or marry with an accounting program. And so, that's maybe you've never heard of that before, but it's a very powerful tax shield, especially for a short-term rental where you get to, especially in today's times, pull forward a lot of depreciation and shield your income. I don't know, Liz, maybe 1 or 2% of people actually considering cost segregation, but
yeah,
it's
it can be monumental.
Yeah, free money that's out there. And, at that point, especially like if you're going to rehab or you just acquired a new purchase, these are, very common. We think these eventually will be standards to do for the STR industry, but they're just not considered now. And, I think as time goes on, this will follow a similar trajectory of single family rentals where, accounting is gonna have to increase. And again, single family rentals, they're a more simple business to keep track of. STRs are more variable. There's a lot more going on. So the need for financial transparency is actually higher on a short-term rental than a long-term rental. So again, we think you would do well to invest time and resources into getting clean books for future, do it for yourself, do it for taxes, and do it for the future sale of either your business on the VRM side or the asset on the STR side.
Yeah, I wanted to add that exact point, Seth. Especially important for owner operators, of larger portfolios, if you're a VRM and own assets, to really have that distinction in your accounting between the opco and the propco for those assets. That's something we rarely see, and it poses a lot of challenges as we're going through, the acquisition and sale process, and trying to get these real valuations for both the business as the operator or for the asset itself and the hospitality business on that. So I couldn't emphasize that enough.
Yeah, so I think that kind of concludes, the four main pillars of investment grade, and we reserve the right to amend these over time as the industry evolves. But we think this is a good framework to use, and the more professional you manage and account and for your business, the better it's going to be for you. So hopefully we added some value.
Awesome. Well, you can learn more about this and download the white paper on this exact topic on our website at revity.com. And join us next week where we'll be discussing the difference between asset management and property management in the short-term rental space, a topic I'm very, very passionate about. So we'll see you then. Thanks.